Welcome to The Explainer. Today, we are diving into a literal game changer, a massive, fundamental shift in the tax landscape for 2026. If you're self-employed, maybe a freelancer, or running a small business, a brand new piece of legislation called the One Big Beautiful Bill Act, we're just going to call it OBBBA for short, is completely rewriting the playbook. Honestly, figuring out these new rules completely changed how I look at financial planning, and we absolutely need to unpack it together.
So, let me ask you, are you leaving thousands of dollars on the table? The reality is most self-employed folks miss out on massive savings simply because they kind of misunderstand how different tax forms interact with each other. They mix up their business expenses with personal deductions, they get totally intimidated by the paperwork, and it costs them dearly. Our goal today is to make sure you keep every single dollar you are legally entitled to. No more, no less.
Now, what's really interesting here is this number, $40,400. That is the massive new state and local tax or SALT deduction cap for 2026. Under previous laws, this was capped at just 10 grand. This huge increase proves it's a whole new ballgame, especially if you happen to live in a high-tax state. It literally changes the entire math behind how you file.
Okay, let's dive into this. Here is our tax funnel roadmap for today. First, Schedule C business deductions. Second, meals and entertainment. Third, mastering the QBI deduction. Fourth, standard versus itemized deductions. And fifth, maximizing your strategy.
Before we really jump into the funnel, let's just quickly define the legislative engine driving all these shifts. The One Big Beautiful Bill Act, which was enacted on July 4, 2025, brings permanent changes to the qualified business income deduction and, as we just saw, significantly increases the SALT cap. We're strictly looking at how the mechanics of this new law impact your tax return, completely impartially.
Section 1, Schedule C Business Deductions.
I want you to visualize this as a two-bucket system. Bucket 1 is your Schedule C, your business deductions. Bucket 2 is Schedule A, your personal itemized deductions. Here is the single biggest myth we need to bust right off the bat. You do not need to itemize on Schedule A to claim your business expenses on Schedule C. They are completely separate. You can deduct all your business expenses in Bucket 1 and still take the standard personal deduction in Bucket 2.
So, looking at Bucket 1, what actually goes in there? Well, things like software subscriptions, advertising, legal fees, these all naturally lower your taxable net profit. And here is a huge administrative relief for 2026. You now only need to issue a 1099 NEC to contractors paid $2,000 or more. That's a huge bump up. No more chasing down tax forms for tiny one-off jobs.
72.5 cents. That's the 2026 standard mileage rate for your business vehicle. It is an incredibly powerful deduction, but here is the vital reminder. You must keep a strict, contemporaneous log of your dates, your destinations, and the business purpose for the trip. A rough guess just isn't going to survive an audit. Basically, no log, no deduction.
Now, let's compare the two home office deduction methods. The simplified method gives you $5 per square foot, capped at $1,500. It's safe, and honestly, it requires way less math. The regular method uses the actual percentage of your home's overall expenses. The absolutely crucial point here is that to use either method, the space has to be used regularly and exclusively for business. Working from your kitchen table while you eat breakfast? Yeah, that simply does not qualify.
Section 2, Meals and Entertainment Rules.
Say you're taking a client out to lunch to discuss a contract. That business meal? It's 50% deductible. But taking that exact same client to a concert or a football game, that falls under entertainment, and under Section 274 of the tax code, it is 0% deductible, literally off limits. You've got to keep meals and entertainment completely separated in your bookkeeping.
Section 3, Mastering the QBI Deduction.
QBI stands for Qualified Business Income. Under Section 199A, this allows eligible business owners to deduct up to 20% of their qualified business income right off their taxable income. It's a huge deal. The massive takeaway here is that OBBBA made this 20% deduction permanent. It's no longer set to expire, which means it is now a totally reliable cornerstone of your long-term tax strategy.
And this brilliantly illustrates how OBBBA drastically expanded the phase-out ranges for 2026. For example, if you're married and filing jointly, you now get the full deduction if your income's below roughly $400,000, and the phase-out doesn't complete until you hit $550,000. The new law genuinely gives high earners significantly more breathing room.
However, there is a major trapdoor if you fall into an SSTB. That's a specified service trade or business. We're talking fields like health,
law, accounting, performing arts, consulting, and financial services. This is known as the SSTB cliff. If your income goes above that phase-out range we just talked about, your 20% QBI deduction drops to absolute zero, just disappears.
Section 4. Standard versus Itemized Deductions.
These are the concrete standard deductions you actually need to beat for 2026. For a single filer, it's $15,700. Married filing jointly is $31,400. The rule here is incredibly simple. You only itemize your personal deductions on Schedule A if your total amount is mathematically larger than these standard numbers. If it's not, just take the standard deduction.
So, what goes into Bucket 2 to actually beat that standard number? Well, Schedule A categories include medical expenses exceeding 7.5% of your income, mortgage interest on up to $750,000 of debt, charitable contributions, and your state and local taxes. And remember that $40,400 SALT cap from the very beginning of the explainer? Thanks to that new cap, taxpayers in high-tax states might finally have enough deductions to benefit from itemizing again. Section 5. Maximizing your tax strategy.
Let's move to and see how this all builds into a highly effective technique called the bunching strategy. Basically, if your personal deductions naturally hover right around that standard limit, you can manipulate the timing. Step 1. You bunch 2 years' worth of charity or elective medical expenses into year 1. Step 2. Because you've artificially spiked your expenses, you itemize in year 1. Then, Step 3. You just take the standard deduction in year 2 when your actual expenses are lower. You are literally timing your expenses to maximize your multi-year tax savings.
Before we wrap up, let's rapidly bust some common errors. Avoid these mistakes at all costs. Do not mix your business and personal funds. Stop skipping your mileage log. Never, ever double count your home office expenses on both Schedule C and Schedule A. And seriously, don't ignore the new SALT math. Proper organized documentation and avoiding that double counting are absolutely your best defenses against an audit.
Which brings us to our final and frankly most provocative question. Are your books ready for April 15th? This massive 2026 tax shift isn't going to navigate itself. You need to proactively track your expenses, apply these new OBBBA strategies, and honestly, consult a professional so you don't miss out on these incredible benefits. Don't let a disorganized shoebox full of crumpled receipts cost you thousands. Start planning today, and I'll catch you in the next explainer.